All right, hello, can someone hear me? All right, can someone hear me? Abiola? Hello? All right, so so what I'm going to do right now is to share my screen. I think we only have Abisola here, so we can wait for some minutes. Let's allow some other people to join. So let's give some time for let's give some time for others to join. Now, Abiola, can you hear me?
Yes, I can.
Okay, so
Can hear you.
no problem. So I think what I will just do right now is to share my screen. Probably when others join, they can meet us along. So I sent a file to the group. I sent a file to the group. So I'm going to share my screen right now. All right, so I'm sharing my screen. When others come in, I'll be admitting them as they come in, but we're not going to waste too much time today. So if you look at what we have here, this is a continuation of where we stopped for sensitivity and scenario analysis. Now, I understand that last week in our last class, we were discussing how to build a complete financial statement model where we did pivot, where we use the pivot table. So what I will suggest is for that class, for that video, the video was of course recorded. So for that video, try as much as possible to learn it up to where we stopped. Okay, so in the course of the week, we'll drop I'll drop a video that will complete that particular lesson, because that particular class was just on financial statement preparation, just integrated financial statement model, a reporting model. We've completed it, almost done. So it's just for the income statement, balance sheet, and cash flow statement to be completed. So I will drop that video in the course of the week. All right. But for today, what I want us to do right now, so that we won't waste too much time, is for us to see how we can complete financial statement forecasting. Because the idea is we shouldn't be, this class is not about financial statement preparation, it's about financial modeling. And when you are doing financial modeling, the place you always start from, um, is that you will have an historical financial statement that will be presented to you. Um, so I'm just doing this so that we can have more people to join us. Abiola, are you with me? Okay.
Yes, I can hear you.
All right. So okay. So doing this so that we can have more people joining us, so we won't have to um, repeat ourselves. But it's fine if after some time. This is 9 minutes past 5, so I think we can start now. Every other person can have access to the video. So what we'll just do now is, now if you take a look at this file, I'll click on this. We worked on this last week or 2 weeks back, so I expect that you should be able to master this. Now, meanwhile, you should note that we are still going to be dealing with annual reports of companies. This class is from August to September. So August is ending, in today's 30th. Obviously, tomorrow is the last day of August. So what it means is that in the course of the week, I might be sending quite a lot of videos. I will send you annual reports probably today or tomorrow. If I can't send it today, I'll send it tomorrow. So I will start doing valuation during the course of the week as well. I will send you video for this year valuation. We'll start doing valuation modeling. The idea is that before the end of September, when you do your final assessment, we should have completed virtually all aspects of financial modeling, and we also do practical case studies. So all this that we are doing is still, I can say, is still introduction to financial modeling. All right. So, so this is assumption. We have worked on this. Now we know how to build assumption. Now, I told you I raised some questions in class that if there's anything you don't understand, you should let me know. Some of you will testify to the fact that I answer your questions any point, at any time, and any day. Even sometimes midnight, I still answer questions. So if there's anything you don't understand, ask questions. All right. Now, so this is the assumption. We're able to see how we work these assumptions the last time. We're able to see how we work on those assumptions the last time. Then we also saw the income statement. We're able to treat this income statement, and also we're able to include ebitda. If you look at what we have here, this is ebitda, this is ebit, this is ebt. So you should have this file, please. Have this file. When you're watching this video, have this file to practice with. It is basic. Preparing financial statements with supporting schedule is basic for you to understand every other aspect of financial modeling. All right. And I will not say because we have a lot to cover, I should be rushing you guys. So we'll just be taking it step by step. Before you know, we are through. Before the end of this course, you'll be amazed how much you would have known financial modeling. All right. So this is the balance sheet. You can see we have also worked on the balance sheet. You can see we have also worked on the balance sheet. The cash flow statement also, we worked on the cash flow statement. If you look at the cash flow statement here, we worked on it and we checked our result that it is fine. We checked this against the cash and cash equivalent in the balance sheet. We also worked on the supporting schedules. We work on the supporting schedules. Now, where we did not work on is, of course, financial indicators, sensitivity, and scenario analysis. Financial indicators and sensitivity and scenario analysis. Actually, in the last class, we did sensitivity analysis, but we didn't talk about scenario analysis. So if you look at the cover page that we have here, you see that this cover page is for S&B PLC, right? Financial statement. And this financial statement, Now, when you are asked to design a financial model, I told you in the last class that your financial model, of course, you have a cover page. The financial model will have a cover page which will include the name of the company, should include the name of the company. Now, there's a way I can do this. I can do this in a quite amazing way, and I will show you that. Now, if you want to design a template, like a robust template, not just for S&B PLC, but you want to design a robust template that can be used, by any company for modeling or whatever. All right, you can actually call this company name. It will not be S&B. All right. So what you would do is you can come here, all right, and say equals. What you can type here is you can say equals, all right, or alternatively, okay, there's something I actually want to show you there, but it may not be necessary here because we have financial statements already. So I actually want to use the text function to combine the company name and financial statements into two, but it's fine. You can just do this, just make it simple. All right, so if I come here and type S&B, S&B PLC, of course, is linked here. So that's what we have there. Now, so let's see. I told you last week how to create hyperlink, right? So if I can click on this financial statement. This is an hyperlink. And click on this financial statement. If you don't know how to do it, you can watch the last video we did. We did quite a lot of examples on creation of hyperlink, and that video was sent to you on Telegram. All right, so I can click on this hyperlink. It takes me to the financial statement for S&B PLC, a simple financial statement. Now I scroll down. If I scroll down, okay, we don't have anyone joining us. All right, so if I scroll down, I come to financial indicators. So under financial indicators, I'm simply going to take out all this. So I'll send you the unsolved file. Okay, I'm going to send you the unsolved file so that you can actually see how we arrive at these numbers. All right. Sensitivity and scenario analysis. So look at sensitivity and scenario analysis here. So I'm simply going to take out all these numbers. So I'll send you the unsolved file. The unsolved file doesn't have any. Okay, it's not necessary I take out this one. So we don't. I will just explain how that link, how we were able to arrive at that link. So the last class we did sensitivity analysis. I'm going to explain this again because I could observe that some of us don't actually have. I'm going to unhide this because there's something that is in here, scenario summary 4. So what I'm going to simply do is to delete it so we can start and see how we actually got all these information. All right, so that's what I'm going to do. So I can take all this out. All right, so it's fine. So we're starting from, you can see we're starting from blank page. Everything is blank. Everything is blank. All right, so when you are doing financial statement modeling, it's important that you include financial indicators. So your financial indicators can come in different ways. All right, but my own style of preparing modeling, which of course most financial modelers also do, is to include financial indicators after the cash flow statement. Because the thing is, when you are reading these financial statements now, you are reading the cash flow statement in line with the financial indicators. All right, you're reading the cash flow statement at the same time you're looking at the financial indicators. So those two things are part of what gives you an overview of the performance, of the company. All right. So let's quickly go into this. Now, we first of all look at the sales growth. How do we calculate sales growth? Of course, we know the growth formula. The growth formula is simple. No, someone is in the waiting room. Okay. Hold on, please. Someone is joining us. Just hold on. Okay, so for the all right, now for the sales growth. Now we know the growth formula to be straightforward, right? Now this is the sales. We have the we've created this here. All right. Hold on. I'm seeing why this number is created. Okay. Okay, I actually included additional table there. Okay, so if I take that out, it's going to affect something. So let's just go ahead. So if we come here to sales growth for 2013, of course, we start from 2013 because it's a growth. So it's going to be, of course, it's going to be we come to the income statement. It's going to be the current minus the previous, okay, over the previous. All right, and you enter. So we can get the sales growth rate for FY 2013 down to 2021. That's the sales growth rate. All right. What's this speaking? That's speaking something. Okay, it's actually because we have a blank page here. Okay, let's just take this out so we can have something that actually makes sense there. So it's fine. So we can work on those other aspects later on. Anything that is affected under the scenario under the scenario analysis. All right, Daniel, you're welcome. If you are just joining us, we've not gone far. If you are just joining us, we've not gone far. So what will happen is after this class, I'm going to unmute everyone so we can ask our questions. Because what we're going to do here is we are not just going to churn out numbers here. We are going to be interpreting. So what we're going to do is we are going to be interpreting results. Okay. Now I can see someone is asking that Oladimeji, I can actually someone is asking that should be him, but I can't actually see Oladimeji right now. I can't see you. Okay. Okay. So so what we're going to be doing is we are going to be interpreting results. We are going to be interpreting results. So today is not just going to be we are turning out numbers and we are saying like other or some other people who will train you on financial modeling will just turn out numbers and tell you this is the data table, this is the sensitivity analysis. Here we are not going to do that. What we're going to be doing is we're going to be interpreting results. Every number speaks. All right. Every number speaks. So we're going to be interpreting results. So we've been able to do this the sales growth. Now, of course, we just do EBIT, financial indicators, EBIT. So we're going to pick EBIT for 2013. Open the bracket. It's going to be new minus old over, close the bracket, over old. Then you press enter. What do we have here? This seems not to be right. Let's see what's wrong there. Well, just the figure is high, so that's why I'm thinking it may not be right. Okay, so let's see. We can do that again. Old minus, new minus old. then divided by this. Okay, let's see. Obviously, we may not be picking. All right, so did I just pick EBIT or EBITDA? I think I just picked EBITDA. Let me be sure I picked the right thing. So this is EBIT, right? So we are picking EBIT. This is EBIT. Okay, so that is like 6.094 to 19.1. So it's a whole lot. So I think it's the girl is right. We are not confused. Okay, it's fine, 214%, but that's actually more than 100%. Okay, so we can take this down. All right, so we had a growth of 240% in 2013. It dropped in 2014, further dropped in 2015, dropped in 2016. It went up between 2016, which is the um, last financial year ending, then to the forecast of 2017. It went up in the it went up in the 20. Hold on, please. I need to admit these guys. Please, let's ensure that we join the meeting early. If once an invite is sent out, once an invite is sent out, let us ensure we join early. So I won't be going back and forth admitting people. It's not so nice. So once an invite is sent early, you can always join before the class starts. So it should just be a case like you're already in and the class starts, everybody is carried along. We don't want to be repeating ourselves all over and all over again. So as much as possible, um, as much as possible, let's try to be timely. All right. So let's look at, so we interpreted this. You can see there are fluctuation here. High growth rate in 2013, prior historical result, drop here, dropped. Now went up in 2017, drop in 2018, went up again. All right. Now here we are having negative here. What actually happened? There must have been um, a drastic fall. So that is actually a decrease. Okay, that's actually a decrease. So what we are having in this instance is here it is actually decreasing at an increasing rate. So we call decreasing at an increasing, meaning that there's no negative number. It's not in negative. It's actually increasing, but the rate of increase is slower here, slower. The rate of increase is high between 2016 and 2017. The rate of increase dropped. The rate of increase also went up here, but it decreased here. So there's a difference between increasing at an increasing rate and actually decreasing, or decreasing at a decreasing rate. So don't get those terms confused. So this is actually decreasing, but in the real sense of it, it is, though it is increasing, but it is increasing at a decreasing rate. But here, it actually fell here between 2019 and 2020 from 15 to negative 2%. All right, so that is what we have for that, for EBIT. Now for EBITDA, I'm just going to be fast here. The idea is I want us to get the interpretation of whatever we are doing and not just doing them. All right, so I'm going to pick this divided by the whole. Now note that this is just one of the financial indicators. There could be many financial indicators. You can have earnings per share, you can have dividend per share, current ratio, quick ratio, leverage ratio, all those ratio analysis we did in our financial reporting. All right, so this is where it comes. When you are preparing financial model, the standard way to do that is at the top, you have your assumptions, followed by your income statement, followed by your balance sheet, followed by your cash flow statement, and followed by your supporting schedules, and lastly, financial indicators and sensitivity and scenario analysis. So please ensure you follow this step one by one. And if there's anything you don't understand, please ask. Ask. We always emphasize the need for you to ask questions. All right. So this is the net income growth rate. It's also the same thing. The same thing going to apply for the net income growth rate. That's same thing as the net earnings. All right. So what I'm simply doing here is straightforward, right? So this is what we have. Now we talk about the liquidity ratio. Of course, the liquidity ratio is, we have the current ratio and we have the quick ratio. So the current ratio just looks at your ratio of your current asset to your current liabilities. Now, you understand that in financial reporting, the ideal ratio that you should have for your current ratio is 2 to 1, meaning your current assets should be the ratio of your current asset to your current liability should be 2 to 1, meaning that if your current asset is 20, if your current liability is 10, your current asset should be 20. And the reason for this is straightforward. You should be able, the business should be able to, should be liquid enough in the sense that the um, the current asset that the company or the business has for a period of a year should be able to cover up the current liabilities, meaning that within the period of a year, all liabilities or obligation of a company should not be more than what the company can offset within that year based on its current assets. So that is what that current ratio is talking about. So an ideal ratio should be a ratio of 2 to 1. But for quick ratio, I think quick ratio is, if I'm right, I think it's a ratio of 1 to 1 for quick ratio. So for quick ratio, you take out your inventory. I think that's just the difference. So calculating this for, so this is going to be for 2012. So we can pick this for 2012. So what we're simply going to do is to look at our balance sheet and select our current assets. So if you look at what is here, cash, of course, is a current asset. So we can open a bracket there and select cash, which is a current asset, plus account receivable is a current asset, plus, yes, inventory is also a current asset, plus. But PPE, property and equipment, is a non-current asset. So this is actually a simple balance sheet. So in this balance sheet, we have actually put all the assets in one category. Ideally, when you are preparing your published account, you should have of course, you should have your non-current asset first. Of course, if there's accumulated depreciation, you subtract that and get your net book value. You understand? Then before you now go to your non-current assets, so that's the way it should be. But this is a simple scenario, a simple case. We don't want to, because we are not treating financial reporting, we're doing financial modeling. So that's why I just made this. This is made simple. It's not. We don't want technicalities in financial reporting here. What we want is we want to achieve our knowledge, upgrade our knowledge in financial modeling. So what you can do on your part is you can revise financial reports and financial accounting, because for you to be able to be sound in financial modeling, you must know financial reporting and accounting, and even your international financial reporting standard, you must be able to have a good grasp of all that. All right, so that's what we have for current assets. Now you say divided by, now go and pick your current liabilities. Now if you come here to liabilities, of course your current liabilities is, open a bracket. Now you have account payable to current liability plus, now you can see that this debt that is given here, it says debt current, meaning that the obligation is repayable within a year. Current is within a year. Non-current is after 1 year. I think we know that. All right. And when you are defining what is current and what is not current, also depends on the operating cycle of the business. What I mean by operating cycle is the time it takes for inventory to be turned into cash. So right from procurement of the inventory to whatever activities that need to take place, and the inventory moves straight to, you understand what I mean? So that is actually operating cycle. So what defines what is current and what is non-current to a business depends on the operating cycle. Some business might have operating cycle of more than 1 year. For instance, a construction company. So for a construction company, what is current may extend beyond a year. So that is what it means. So you can read up that further in financial reporting, but this is financial modeling. So let me just tip in that. Now, so what will happen here is I believe we have all joined. I don't want anybody to be left out. I can see 2 people here. Let me admit. Okay. Okay. All right. So, I've admitted those guys. I've admitted those guys. All right. So, what we'll do here now is to pick debt, which is our current, which is also current. I think that's all. So we actually don't have any other thing to pick. So I can press enter. Now, if you press enter, you see that this is 3.36. 3.36 is actually a good standing for this company because the company's current, what this means is that the company's current assets is able to cover up its current liabilities, meaning the company is liquid. Okay, the company is highly liquid. This company is highly liquid. This company is highly liquid in 2012. You can see the standard is 2 to 1, but this is actually 3.36 to 1, and that makes a lot of sense. All right. So for the quick ratio, now what the quick ratio will just do is the quick ratio is similar to the current ratio. The only difference is that for quick ratio, you are taking out inventory because inventory is not really that liquid. So you're going to want to take a look at those items that can easily be turned into cash. You know, that can be easily turned into cash, or they are more like near to cash. You know, that's why it's called quick, because you can easily those are easy. How will I put it? They are very liquid. If I can use the word very liquid, so that's why it's quick. So for quick ratio, we take out inventory. So what I'm simply going to do is to come to where I have the balance sheet. So I'm just going to pick this, which is the assets. Most of us are used to these accounting ratios already. It's just that it's necessary because we're going to be doing sensitivity and scenario analysis. So we might need to be interpreting. I just have to show you some things. It's basic. Once you understand this, you have understood whatever it takes to prepare financial modeling. All right. So I'll pick this. I don't want to assume that we all know this. So that is why I'm doing this. Otherwise, I would not even do all this. I would just give you a soft template that has all those things. What we'll just do is just go straight to sensitivity and scenario analysis. Then we'll now start interpreting the results vis-a-vis what we have in this financial statement. Because when you are called for a management meeting, that is what you do. That's what you do. You speak to your numbers. You cannot just be churning out numbers. All right. So that's what we have. So we're not going to pick inventory. Then say divided by. Of course, we'll pick account payable, and we'll pick plus, we'll pick debt, current. Great. So you can see that for current ratio is 3.36, but for quick ratio is 3.2. So if management is saying you're trying to assess this business, you're saying like, okay, this company is liquid to the extent of 3.36 to 1, and it's even more liquid to the extent of 3.21 to 1. So that is what this means. Okay, for instance, the business is facing liquidity problem. How quick can you easily realize cash? You look at the quick ratio. More from the quick ratio will tell you more, will give you more insights than the current ratio. So we can take this down up to the forecast period. So you can see how do we interpret this. Now you see that the quick current ratio is actually is increasing here. It increased, is increasing actually 6.49, 7.2, 8.81, 9.32. So it's actually increasing all through. It also went up. So this business is actually a great business, highly liquid business. It's highly liquid. Now, if you look at the current ratio, you see the business is highly liquid. The business is highly liquid. So this is just aspect of financial analysis we're talking about this. You can see our modeling is not just looking at just financial statements modeling. We're also looking at financial analysis. But we cannot take a look at, because this is not the financial analysis course. What you can do on your own is the little you have learned here, try to build on it. Get as many Excel models unsolved. You can check online, you can look at, buy books, do a lot of things, make research on your own, and try as much as possible to practice. I must tell you that practice is important, otherwise you will forget. Okay, so let's look at leverage ratio. So when we talk about leverage ratios, leverage is actually talking about the debt. What is the ratio of your debt to your total capitalization or your equity? All right. So we can pick leverage ratio here. Now, if you take a look at what we have here, let's do leverage ratio for 2012. Leverage ratio for 2012, of course, is going to be the total. We have the total debt to total capitalization. So the total debt we have here is for current assets. Debt is actually current in the balance sheet. So let's go to the balance sheet. So balance sheet, we have the debt to the capitalization. So capitalization is the equity and retained earnings to give us our capitalization 770.24. So we're going to pick this, which is the shareholders equity. All right, so I'm just going to press enter here. I'm just going to press enter here, and I'm going to, okay, now please don't get that wrong. Now for total debt to total capitalization, okay, now total capitalization is made up of debt and equity, right? So it's going to be this plus, please don't forget, it's going to be this plus, we're still going to add C54, okay? So capitalization is all of your equity plus your debt. Equity plus debt. You know, normally the company's capital structure is made up of debt. Debt capital and equity capital, you have equity and the debt. You know? That's the equity and the debt. You know? So Apollo's video must have paused for some time. So if you are with me, let me know. This video must have paused for some time. Can someone hear me?
Yes.
All right, thank you very much. Okay, so now for total debt to total capitalization, so I've shown you how this formula works. So what I'm just simply going to do is to take this down here. All right, so you should be able to interpret this result as well. What this means is you look at the historical result. From the historical result, you can see that this is actually decreasing. It is increasing at a decreasing rate. Please note my word. It is increasing at a decreasing rate. Because if you are saying it is decreasing, you may be wrong. Because you look at when you have negative here, you can see in the EBIT growth rate, we are having from 15 to negative 2%. This is actually a decrease because it's actually decreased here. But here it went up. Here it's increased, but at a decreasing rate. So meaning that the net effect between 9% to between 2018 and 2017 is lower than what it was between 2016 and 2017. So let us know how to interpret results. So when you say something is increasing at a decreasing rate or decreasing, when it's decreasing, it goes negative. All right. So for total debt to total capitalization, you can see it went down here. I would rather use the word went down rather than saying it's decreased. So I'm selecting my words carefully. I'm not saying it's decreased. I will say it went down. So it went down here, went down, down. Then this is also down by 1%, down by 5%, down by 1. Okay, up by 1%, then down by 1%. So you can say down and up. You cannot say increase and decrease. Just for you also to be able to differentiate between what is going negative and what is still positive. All right, so for total debt to equity, Of course, total debt is going to be, we only have current debt, we don't have non-current debt, right? Balance sheet. So I'll just go to the balance sheet and pick this and over equity. So this now. So you can see I'm not adding debt again. I'm not adding debt again because it's not capitalization, it's just debt to equity. Capitalization, you have to put debt and equity together. Do you get? Yeah. So that's what we have there. Now you can pick this and go down. So that's exactly what you have. You can see that the trend here is going down for the historical year, it went down here. But for the forecast period, you can see it's going down, going down, going down, going down. So the idea for financial modeling is when you are changing all of this, your assumptions here, in a way, it's going to be affecting your financial indicators. So if you are in a management meeting and you are making a presentation, as you are doing your assumptions, you are changing these numbers, please ensure you note the effect on. If I were you, what I would simply do is this. If I don't want to see this information, for instance, that's why it is good that you group the last time I showed you how to group, I think some of you understand how to do this. It's very important. If you don't understand anything, tell me. Now, what I will simply do is I will check this, check this, check this, check this, check this, right? I can uncheck this, okay? Okay, I think that's fine. I can uncheck all that. I can even go as far as coming here and hide. Do you get? I can go as far as coming there and hide. So what I just want to do is I want to see the immediate impact of these scenarios, not scenarios, the immediate impact of these assumptions in the forecast period on the financial indicators only. Because I'm changing all this immediately, I'm seeing whatever impact it will have on the financial indicators. So I can tell management that, okay, if revenue growth rate increase from 4% to 3.5%. Of course, we should know that that is going to have an impact on the sales growth rate. It's going to have an impact on EBITDA. It's going to have an impact on net income, right? It's going to have an impact on the total debt to total capitalization and also total debt to equity, because when you talk about your net earnings, for the current period, of course, your net earnings is going to affect your retained earnings. And once your retained earnings is affected, your equity is affected. So it's going to change all this. So looking at the big picture, you can be changing the scenarios. Why do I keep saying scenarios? So you can be changing the assumptions and be seeing the immediate impact on the indicators. So that is what I'm talking about there. So I will unhide this again, so we can go to the business of the day. So when I scroll down and so successfully we've been able to indicate all our financial, we've been able to show all our financial indicators, right? Now let's go to the real business, the real deal. Please, I want you to listen attentively again. And Daniel, if you are here, you specifically asked that you do not understand how to do sensitivity analysis. We are going to go more advanced, because if you don't understand how to do sensitivity analysis, then understanding scenario analysis will be more confusing. So please understand this again. And if you see what we have here, you can see that we have made improvement from where we stopped in the last class, because in the last class, we only did sensitivity analysis. We didn't talk about scenario analysis. Excuse me. We didn't talk about scenario analysis. So what we want to do now is to go more advanced. So this is advanced financial modeling. So we are dealing with advanced financial modeling now. Now, so let's go to sensitivity analysis. Now, let me explain what sensitivity analysis is again and what it is used for. Now, when we prepare financial statement, whether it's historical or forecast period, but most often times for forecasting, whether it's budget forecast or financial statement forecast, whether it's budget preparation or financial statement forecast, we do sensitivity analysis. And what do we mean by sensitivity analysis? Sensitivity analysis, we just show the impact of changing any of your input, your the input in your financial statement on a defined output. What do I mean? In your financial statement, you have what makes up your assumptions, right? Now, those assumptions that you use to do your forecast are the input. Are you getting me? The impact of those assumptions on your financial statement are the output. I'm going to repeat myself. In financial statement forecasting, we make assumptions. Those assumptions that we make are the input into the model. The impact of those assumptions are the output. Sensitivity analysis will tell you what is the degree of the impact of those assumptions on those outputs. That is what sensitivity analysis will tell you. So it's going to tell you the degree in the sense that it's going to show you the different outcomes that you will have. What I mean by degree is that it's going to show you the different outcomes, the different possibilities that you will have based on different assumptions that you have defined comprehensively in a table. That is what it means. So what we're going to do here is that sensitivity analysis is in two ways. We have for two input sensitivity analysis and one input sensitivity analysis. I will explain the difference between the two. Now, for two input sensitivity analysis, right, you're going to be picking just one input, which is the column input, meaning that we're going to be picking here is just, I'll highlight this. What we're going to be picking here is just this. This is what we're going to be picking for one input sensitivity analysis. But what you will now do is that for this, you're going to pick this from your financial statement. Now, let me give you a scenario. Assuming you are the financial analyst of S&B PLC, and your CFO asks you, Wale, can you please give us a sensitivity analysis? Assuming we have, okay, this is the case now. Your boss, your CFO tells you, we are projecting that for 2021, we're looking at different we are looking at different growth rate between the range of 1 to 10%, right? And we, of course, want to see the impact of this growth rate on the net earnings, the earnings before interest and tax, the earnings before tax, and the earnings before interest, tax, depreciation, and amortization. Depreciation and amortization. All right, so what we'll simply do here is, now you come here. Let me take all this out again. So we start afresh. So what we'll see here is that you want to take 2021 as a case study. And you're seeing that 2021, of course, 2021 is a forecast year. Okay, so what we're simply going to do here is you're going to look at, you want to see the impact of the growth rate on each of these variables. So the first thing you're going to pick is the net earnings. So you will go up and go and pick net earnings for 2021. So I'm picking net earnings for 20. You can see what I'm doing. So I go up and pick net earnings for 2021 and I press enter, right? Now I go to earnings before interest and tax. I say equal to. I go up and pick earnings before interest and tax. I come and select this for 2021, right? Now I come here and say earnings before tax for 2021 as well. Earnings before tax. So please, mind you, it can be any variable here. It can be any of the stuff that you have calculated, not just EBITDA, EBIT, or anything. You can use sensitivity analysis for anything. So it's not peculiar to EBITDA, EBIT, and EBIT. And we are just using this as a scenario. You should take note of that. So it's not in all cases that you will see any settings, EBITDA, whatever. So this is just a scenario. All right, so EBITDA, fine. So we have picked all that, and we have also defined the growth rate. All right. So if you are with me up to this level, it is great. If you understand what we have done up to this level, it is great. So let's move ahead. So what we're going to do next is, you can see we defined this. What is written here is sales growth rate per year. All of this, right? So
Is it my network or the person's network?
So we're going to select everything that we have here. If you can hear me, can someone hear me? Yeah, can someone hear me?
Yes, I can hear you.
Okay, so let's go ahead. So what we're simply going to do here is we're going to highlight everything. All right. Now, please follow me. All of you follow me, so we don't get this place confused again. The reason why I'm overemphasizing this is that when we get to annual report, we start using annual report. We're not going to be going into details. I will just assume you understand all this. I will assume you understand all this. All right. So what I'm simply going to do here is in home, we'll just come to data, right? What if analysis? Are you getting me? Now you come to data table, select data table. Now, because this is a one input factor, are you getting me? It's a one input factor. So what you're going to do is just for the column alone, just this column, right? Now look at this column that we have here, the column input cell, right? Now you scroll up, the assumptions that you are referring, that you want to refer is the assumption that you want to refer is revenue growth, which is a percentage change, right? So for 2021, you pick this. You can see what I'm selecting. You pick this. Then come down so that you can see the impact of what you have selected on your table. So I'll put this here. So let's see the impact of what we have selected here. I'll click OK. So you see the impact now. You see what happens there. Now let's interpret what we have here. Now, if we check what we have here, so this is what we call a data table, right? And this data table tells us a lot of things. It tells us some, excuse me. So this data table tells us a lot of things, right? Now, one of the things this data table is telling us is if we have the net earnings in 2021, for instance, of course, we made an assumption that in 2021, we expect our revenue to increase by 3%. Now, if our revenue went up by 3% in 2021, what it then means is that our net earnings will be 48,185. Our EBIT will be this, our EBIT will be this, and our EBITDA will be this. If it is now 2%, okay, our net earnings will be this, EBIT will be this will be this, like that. So that is what it means. Do you get? So let's see if this works. I'll put this yellow. All right. I'll put this in yellow. Okay. Then I'll come here. Take note we have 49018.89, right? That's for 2021, isn't it? The sales growth is 2%. I will scroll up and I'll come and change this to 2%. If I change that to 2%, what do we have? Now, we are looking at the impact on what? We are looking at the impact on net earnings, Abby. So what do we have for net earnings for 2021? You can see it's correct, isn't it? So net earnings for 2021 is 49018.89, which is exactly the same thing we have here. Can you see that? So what it then means is that, so what this table will tell you is that instead of you coming here to change your assumptions, you are picking one, pick two, pick three, you are trying, everything like that. You are just preparing a table. This entire table will give you an holistic picture of what the different performance metrics will result to if you have this range of growth rates. Is that understood? All right. So that is it for a one-factor sensitivity analysis. If you see what I have here, I've told you that this is, let me just show the comments. So I've told you that this is a one-factor sensitivity analysis. Now let's go to a two-factor sensitivity analysis. For a two-factor sensitivity analysis, you're going to be considering both the column and the row. All right. So what I'm simply going to do here is we want to take a look at now for a two-factor sensitivity analysis. We want to take a look at EBITDA and at the same time sales growth rates, right? But what we are saying here is that we are not just picking one assumption. We are not considering just here. We are considering just one assumption, which is sales growth rate per year. But here we are taking two assumptions, which is cost of sales to sales ratio and sales growth rate per year. Do you understand? So cost of sales to sales ratio will be horizontal, while sales growth rate per year will be vertical. All right. Now you see that this is for EBITDA because here management is asking you as a financial analyst that can you tell us what the impact on EBITDA will be for FY 2017 if we have cost of sales to sales ratio between 5 to 11% and sales growth rate per year between 37% to 49%. You understand? So the first thing we do is here, I will take this out again. Right. So what I would do is I will just come here and say equals to. Then I'll go and pick EBITDA. You can say EBITDA for 2017. I will go up and go and pick EBITDA. EBITDA. This is EBITDA, right, for 2017. So I'm picking 2017, EBITDA 2017, and I'll press OK. All right. So that's the first step you take. All these ones are coded except for this I pick directly, but it doesn't matter. It doesn't matter. I can as well type 5% directly. So all these ones are coded. All these are also coded, but this is not coded because you pick this directly from the income statement. Because what we now do now is follow this step again. You highlight everything that you have here. Highlight everything that you have here. Then come to data. Select data. What if analysis? Okay. Then click data table. I click data table. Okay. So what you now do here now is this is a two-factor input. Now the row input cell, this is the row, right? The row is cost of sales to sales ratio, while the column is sales growth rate. Now you go up again, take this so we can see what we are selecting. Now cost of sales to sales ratio is a row. I told us to mute our mic. Please mute your mic. So cost of sales, cost of goods sold as a percentage of revenue, you pick, which is the row, pick 35. Then sales growth rate, which is the column. Sales growth rate, this one, come here and pick 2. Okay, so you can now come down, put this by the side here. All right, put this by the side here. I just went to press question mark so you can take me to all those nonsense. All right, so sorry, please. So scroll down. I think we have selected all that we need to select. Let's do that again. So for row input, the row is the revenue growth, which we have selected here. So revenue growth, which I have selected, then the column is cost of goods sold. Let's be sure we select the right thing, which is 35%. So I come down to where we have so let's be sure we selected the right thing. Now, the cost of sales to sales ratio is the first thing, which is the row. I don't know if we selected the right thing. Oops. So what I will do here is this. Please. Let's see how this goes. What I will do here is this. I'll simply change this table. Please follow me, please. What I will do here is this. I think this stuff. There's an issue with this stuff. So what I will do here is this. This will go up here, okay, and this will come down to indicate that what we have up here is sales growth rate, and what we have up here is cost of sales. So the row is growth rate, the column is cost. The row is sales, the column is cost. So let's do it again. Home, data, what if, data table. So we'll go up, the row is sales. Row is sales, column is cost. Okay. So let's come down here and click on OK. So this is what we have. But I think something is wrong here. I think something is wrong here. So let's see what we must have missed, because this is not actually giving. Did we define this rightly? Let's see that we pick the right thing here. Let me go up again and pick ebitda.
No reason.
Hold on. For 2017.
Hello.
Yeah, look, can someone hear me? Okay,
Yes.
okay. I think we were picking.
You
Can someone hear me?
2021.
So we were picking 2021. Yeah. Yeah, you are correct. I understand. We were picking 2021, which is wrong. So that's why it's giving us a wrong number. So let's pick 2017. So we're picking 2021 for those assumptions. Exactly. So we're picking 2021 for those. We should have picked 2017. So once we come here and go up, so that means someone is actually following me, and that's nice. That's nice. So this is we pick here for the column. We pick here. So we can come down now and see what happens. All right. So this is correct now. Please let's reduce the background noise, please. So this is correct now. So ensure you pick the. You can see. You should be able to know if something is wrong, because at that time the initial one we did. Initial one we did was actually giving us 74 constant. That's not possible. What it means is that Excel did not recognize that calculation because you didn't select the right number. All right, so it's for 2017. We picked 2021 before. That's wrong. So it's 2017. So now let's interpret this. So what this means is that we have sales growth rate within this range, and we have cost of sales to sales within this range. So these are the various impacts on ebitda. These are the various impacts on ebitda. You can see this makes a lot of sense because it is actually an holistic view. It's actually an holistic view. So you can do this for the impact for different years. You can show this. You can do this to show the impact for different years. Okay. All right. So how do you interpret this? Meaning that if the sales growth rate is 6% and the cost of sales to sales is 39%, the EBITDA will be 62,489. If it is 9% here and 41% here, the EBITDA will be 61,961.47. So that is how you do sensitivity analysis for one factor input where you are selecting only the sales growth rate, two factor input where you are selecting sales growth rate and cost of sales. So it may not be all the time. It may not be this one and this and this. It can be any of the assumptions that you have used. You may decide to pick salaries and benefits and revenue. You decide to pick rent and overheads, and you may decide to see sensitivities of any of these assumptions on your performance metrics. Do you get? In fact, sometimes you may want to create a dashboard or a KPI template sheet here that will just show you an holistic view of all those information, sensitivity, scenario, and what have you. So let's go to the last part. So this is the last part, which is scenario analysis. Now, when we talk of scenario analysis basically is used to show as the worst scenario, whether you have a bad scenario, a good scenario, or something. That means we have optimistic or pessimistic. In some financial modeling literature, you will see best case and worst case. So we have what we call base case, we have what we call best case, and we have what we call worst case. Your base case is the same thing as current value. Your best case is the same thing as optimistic case, and your worst case is the same thing as pessimistic case. Now we'll see what all that means. Now, when you are doing sensitivity analysis, of course, you look at all these, when you're doing scenario analysis, rather, you look at all these assumptions that you have made. Now, these assumptions that you have made, everything is here, right? Now, each of these assumptions that you have made, okay, is actually a base case. If I say, for instance, what is the impact of having revenue growth rate at 5% and cost of goods sold at 37%, flat rate of salaries and benefits of 25,000, rent of 10,000? What's the impact of all of this on my EBITDA, my EBIT, and my EBT? That is a base case because it's actually a current case. Current in the sense that though it's a forecast, but that is the position will be in the future. That is the unaltered position without saying what if it could be better or what if it could be worse. Do you understand? So when you now move forward from the base case to say what if it could be better, that's optimistic. You are being optimistic. What if it could be worse? You are being pessimistic, right? Now, the first thing you will do for scenario analysis, is to prepare a table, a simple table like this, where you will have your first scenario analysis, current value, optimistic and pessimistic. Then you will have your changing cells. Are you getting me? These are your changing cells. Your changing cells are your assumptions. Most often, they are your, not most often, your changing cells are your assumptions. Are you getting me? While what you will have underneath your changing cells are your outputs. Scenario summary. We can call this one scenario summary or scenario output. These are your assumptions. These are scenario outputs. So these are your assumptions, which you have current, which you have optimistic, and which you have pessimistic. When you define this properly, Excel will return your results. So if at the current position of 2017, Excel will give you what the EBITDA, EBIT, and anything will be. If you're now optimistic that this can improve, Excel will tell you what it will be. If you are pessimistic that no, it will not improve, Excel will tell you what it will be. So let's see how we do this, and this is quite interesting, so you should listen. Now, what we do first is you still come to home. Is someone following? Is someone with me?
Yes.
All right. So okay. So you will still come to home. From home, you will come to data. What if now this time around we are selecting scenario manager? Okay. So I'm going to delete what we have here before. Now I'm going to be performing some analysis here. So please follow me. It's step by step. It can be quite confusing, but just follow me step by step. All right, so the first thing you're going to do is you click on Add. Now, when you click on Add, it tells you scenario name. Now, scenario name, the first scenario name, based on what we have said here, assuming you call this base case, you call this base case, best case, worst case. That's what you will define here. You understand? That's what you will define here. But what we define here is scenario name. We're not going to put current value because current value is automatically what we're going to select. And Excel is going to recognize that in the scenario summary as current value. But what we're going to put is, we're going to simply say optimistic. We're going to simply say optimistic. Okay, you can see maybe I do that. Excel will give me created by Wilson, but this is actually created by me. It will tell you today's date, the date that I created it. I'm creating this scenario on 30th of August 2020. All right. Now, what you now do is, you can see these are the changing cells. The changing cells are your assumptions. Okay. So, we want to pick revenue all for 2017. So, you go up and pick revenue growth for 2017, which is this. Now, after you do that, you say comma. What's the next thing we are picking? Let's see it. We are picking cost of sale, cost of goods sold. Cost of goods sold is the next one, Abi. Yeah, cost of goods sold is the next one, 37%. You say comma. What's the next thing you are picking? Depreciation and amortization. Depreciation and amortization, that's this row. Abi, you pick this, then you say comma. What's the next thing we are picking? We are picking interest. We are picking interest. So let's see, that's this. Okay, so immediately you do that. Okay, immediately you do that. What you now do is, okay, just click on OK. Now, once you click on OK, it brings you here, scenario values. Now, scenario values is optimistic, isn't it? We are optimistic. Now, if the current, please listen attentively, please. If the current assumption that we have made is that we expect revenue growth rate to be 5%, 37% for cost of goods sold, and 40% for depreciation and 3% for interest for 2017. Automatically, that is the base case. What we have here is the base case. Now, I want to define optimistic case. So, optimistic case will now be a situation like this. You will come here and you will say, this is no longer 5%. We don't want it to be 5%. We don't expect. Okay, now, if we optimistic case for revenue growth, of course, it will increase. Please listen. Optimistic case for revenue growth is that we expect revenue growth to be more than 5%. So we can say 6%. All right. Now, what is the optimistic case for cost of goods sold? If cost of goods sold as a percentage of revenue increase, we are not better off now, Abi. So meaning that if cost of goods sold as a percentage of revenue decrease, it means our gross margin will increase. So our best case scenario would be 36% instead of 37%. I don't know if someone is following me. So here we can say 36% because it was 37% as a base case. So optimistic of 36%. Now you look at what again? The next one we pick is you look at depreciation and amortization. Okay, depreciation and amortization. Is it depreciation? No, salaries and benefits. Now, for salaries and benefits, of course, because it's 4% here, we can say best case scenario, let's say 30%. 0.4 is 40%, right? So 30% here, it should decrease. We also have a best case. Now,
Is this salary and benefit?
Salary, yeah, it's depreciation and
Depreciation
amortization.
amortization, yeah.
Amortization, age 14.
You said?
Age 14 is depreciation and amortization.
Age 14 is, we have not gotten there now.
No, you are talking of salaries and benefits.
That's what it's supposed to be in the cell we are working with right now.
Okay, age 14, sorry, thanks. So age 14, you can see it's 40% here. So what we are saying now, we want to pay 30% because age 14 is depreciation and amortization. So if it is lower, it means it's better for us, right? That's an optimistic case. So if it is 40%, we can say 30%. Thank you for that. So this is 30% here. Now the next one is interest, right? Interest. So interest here is 3%. Best case will be for us to go lower because we don't want to pay too much interest. So best case is for us to go lower at 2%. Assumption. You guess now. So here we can say okay. So once we click OK, we have defined our optimistic case. The next thing you now go to is you just say add again. Now add, you now go and define your pessimistic. You say pessimistic. Now for pessimistic, the changing sales value, you're not still going to touch this. Okay, you're not still going to touch it because it is the what I call it is the base case. Okay, it's the base case, so you're not going to touch it. So what you're simply going to do is just click on OK. It takes you here. So let us be pessimistic this time around. We don't want to optimistic. We don't want to be optimistic in 2017. We want to be pessimistic. So if we are pessimistic for revenue growth is not going to be 5%. It's going to be 4% because we are pessimistic. So it's going to be 4%. Cost of goods sold, we are pessimistic, so it's going to increase 38%. What again? Depreciation and amortization, we are at 40%, so it's going to increase, let's say 45%. Then interest, we are at currently at 3%. It's going to increase, let's say at 4%. So what we are simply doing here is that you are looking at different scenarios. You are saying that, okay, well, I expect that based on the central bank monetary policy, blah, 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 I expect that no inflation, interest rates will increase. It's not going to decrease. Or I expect that it will decrease. It's not going to increase. So those are scenarios. You are just seeing scenarios. You are trying to see what will be the outcome on your financial performance. Okay. So here you will click on OK. Fine. So we have defined optimistic and we have defined pessimistic. So what we now simply do is just to click on scenario summary. Just click on summary. You click on summary and you see scenario summary. Don't click on scenario pivot report because you don't want it to be in a pivot report. You want a summary. So leave this as it is because as you are seeing, this thing has already selected assuming this thing is not here. Are you getting my point now? Assuming this is not selected already, okay? What we'll do is to select it because if you take a look at what we have down here, if you take a look at the scenario outcome, the scenario outcome will look at EBITDA, EBIT, EBIT, and net earnings, meaning for both optimistic and pessimistic case, what will be, Razak is just joining. We can't, this is late already. So, so what will happen is this is EBITDA, EBIT, EBIT, and net earnings, right? So we have already picked it, so we don't need to start doing it. I just want to show you what has been automatically picked, but it's not going to come automatically. Excel is not going to pick anything for you automatically, but does that this has been done before. That's why it's there. So I don't want us to start doing it again. So this is what it picked. You understand now? So what we're simply going to do here is just come here. Let's see what will happen. So if I come here and click OK, so what will happen is Excel is going to be running a report. So that's the report there. Please let me admit someone. Okay, sorry. So this is the scenario summary here. This is a scenario summary. So what Excel will do is that Excel will automatically create a separate sheet for you, a new sheet for you in your workbook. This is a new sheet in your workbook as a scenario summary. So what we're going to do is that this workbook that is here, you are not going to show it in your report. You are going to hide it. Are you getting me? Now, before you hide it, you will come to your financial statement and format a table like this. Do you understand? This table will be formatted by you. So what you will now do is, in this current value, just link it, go to scenario summary and pick current value here. You can see this is the current value. Select this one and press OK. Then take it down like this. You see? Then come here, go to scenario summary, select optimistic, take it down, take it this way and drag it down. You see what you will do? Then come here, current value, go to scenario summary, select this and take it down like this. Then come here, select this, take this down like this and take it like this. Perfect, you are true. So this is your scenario analysis. So what you will now do now is you will hide this. Exactly. So nobody should be seeing your workings. In financial modeling, they should not be seeing your workings. It's just like in the way when you are writing strategic exam, strategic financial management, NICAN, you can't be showing your workings in your where you have your solution. Your workings should be separate. So it's only when someone asks you for your workings, you can now say, okay, you want to unhide and you want to show your scenario summary. This is your scenario summary. You understand? But you have to hide it. Now, so successfully, we've been able to do scenario sensitivity analysis and scenario analysis. So now look at this scenario analysis. We have our current value for 2017 to be this, Abby, right? and we have the optimistic. If we are currently at revenue growth rate of 5%, and we're optimistic that this revenue growth rate will increase to 6%, then of course you can see that. So we are interpreting these results now. We are currently at 5% based on our forecast for 2017, and we're optimistic that it's going to increase in 2017 to 6%. Are you getting me? So this 6%, it means that the impact it will have on EBITDA is going to increase EBITDA. Of course, it's logical. EBITDA will increase from 69 to 70. Now, if we are pessimistic that it will be 4%, then it will fall our EBITDA. EBITDA will fall to 68. If we are currently at 37%, and we are optimistic that cost of goods sold to percentage of revenue will drop by 36%, what will happen? Of course, it's going to impact our EBIT positively. It's going to impact our EBIT positively. You can see 53, and it's going to, if it is pessimistic, it's negative, 53.9. Look at EBIT, look at net earnings as well. So that's the interpretation. That's the interpretation. So what I will now do now is I'm going to unmute in case you have question. Please ask. Because we have ended the class for today. Please ask your question.
Hi, Wilson, thank you. I think I understand the sensitivity better now. Okay, so one very important thing I would like to understand. When you are doing this sensitivity analysis, the year in which you want to check its sensitivity, meaning that's the year you have to pick directly, right?
Yes, of course. That's the year you want to. That's the year you have to pick.
That's the year you have to.
Hold on, please. Let me get my earpiece. I'm coming. Okay, I'm with you. Do we have any other question?
Okay, so another thing is sorry, I think I typed the question recently. Our supporting schedule, that's the workings for our key figures, right? Did you get that?
Yeah.
Did you get that? Did you get that?
Can you repeat that question?
I said the supporting schedule. Is that our workings for some key figures? Because what I can see in the supporting schedule in the sheet here with me is the workings for account receivable, working capital schedule, depreciation schedule, debt and interest schedule.
Yes.
So these are the workings for some key inputs in our model.
What's the question?
What close now? I want to work close on this. I'm almost through this.
Please, let's reduce the noise. Let's reduce the background noise, please. I have to unmute all of you because I want questions. Please, let's reduce the background noise, please. So, what's your question?
Okay, sorry. The question is for that scenario analysis. The last part of the net earnings for the optimistic case is a little lower than the current value or the base values. Is that supposed to be?
The net earnings for what?
The net
earnings for what? I didn't get you.
Any case is a little lower than
the base. Pessimistic or the optimistic?
Optimistic.
Okay, the optimistic case is the optimistic case is a little lower than the current value.
For net earnings.
That's current value. For net earnings. You now look at what you now look at is what are the assumptions that you gave there. If you check now, you look at the assumptions holistically, right? Okay. Now you check for revenue growth. Revenue growth is 5% here. Optimistic. Of course, if you are, just look at it holistically. If you are optimistic, Okay, if you're optimistic that revenue is growing from 5 to 6%, now you are also optimistic that cost of goods sold is from 37 to 36. Let's see, yeah, which is optimistic. Depreciation 40% to 30%, well, which is also optimistic. Now interest 3% to 2%, which is also optimistic. So it means the net earnings, that the net earnings should actually go up.
Yes.
Now I understand. Yeah, it went down. I understand what you are saying there. So we have to look at what we have said. I think that's just one of the exceptions. I'm going to like that. That's
Okay.
a good one. That's a good observation. The net earnings should actually
Increase.
The performance for the net earnings should actually improve. Yeah, that's true. So it's just
likewise other ones. EBIT.
EBIT and EBT. So if we check EBIT, okay, EBIT also dropped. Then EBT also dropped. But EBITDA improved.
Yes.
Okay, now let's look at it this way. I think we can give an interpretation for this. Let me see the interpretation we can give for this. Because the fact is that, okay, I will highlight all that. Now, thank you for that question. Because it's actually giving us more insights into this. Let's analyze this further, right? So we are all accountants, so we're speaking the same language. Now, if you look at it, because the first thing is you have to look at, if you observe something like this, then now you have to look at your steps. Have you missed any steps? If you have not missed any steps, you have done it the way it's supposed to be done, then Excel is garbage in, garbage out. Once you miss a step, it will give you incorrect answer. But once you get the steps right and you have cleaned your data, the data is correct, your input, your output should be correct. Now, if you take a look at this EBIT, EBT, now please reason this along with me. Okay? If you have further question, you can ask. If you take a look at earnings before interest and tax, earnings before tax and net earnings, right? Take a look at these three things and take a look at EBITDA. Can you tell me the difference between all this and this related to what the scenario we have defined here?
EBIT is after depreciation and amortization.
EBIT
is
okay,
after
EBIT
depreciation.
is after depreciation and amortization, right?
Yes.
EBIT is after depreciation
And amortization.
That's correct. All of EBT.
EBT is after interest, before tax.
After tax. The net earnings is the bottom line.
After tax, yeah.
Right? Yeah, after tax. Now, if we look at all the assumptions that we have here, you will observe that these assumptions relate most oftentimes relate directly with EBITDA, because you look at revenue. If you pick revenue and you pick, if I pick these two, I don't know if someone is getting me. If I pick these two focus more on EBITDA. Isn't it? Now, yes, of course, it's focused more on EBITDA, because before you can arrive at your EBITDA, you must have your revenue. You take away your cost of goods sold to get your gross profit, and you take out your OPEX, isn't it? So the only thing we are not having here to get at EBITDA is OPEX, but we have revenue both and we have cost of goods sold. I think that is one reason why we can see here that for EBITDA is having a direct positive impact. There is a direct positive impact on EBITDA, but there's no direct positive impact on EBIT. Are you getting me? Because here, of course, we have depreciation and amortization here, which is before EBIT. I guess what I'm trying to say. So depreciation and amortization, these two. So the reason I'm giving for this is that these two is what is causing this effect here. These two is what's causing this effect here. That's the logical explanation I can give to this. Because if you look at the steps are absolutely correct. There's nothing wrong with our steps. Except for the fact that we just want to say EBITDA here, which is the measure performance metric, is what actually interprets this result. I don't know if someone gets if someone is getting me right.
Yeah, we can follow.
But is it understood? It's my own explanation for this understood. That's what you should have.
But
There's nothing
hello,
wrong.
on
Yeah, I can tell you.
a normal times, when we have
Okay.
an optimistic case, it should be expected that these metrics should go up, meaning we have higher revenue, lower costs, lower depreciation, lower interest. So the net effect should flow to net earnings. So giving us a lower effect now, because if we just look at the EBITDA alone, we may make a wrong decision, in my own view.
Yes, that's true. That's true. I think what will now happen is we might look at another financial statement entirely. But let's see. Okay, let's look at this now. So even if we look at the OPEX, it's still the same thing. We can actually look at the OPEX because I actually want us to look at the OPEX. Let's see the changes in the OPEX to see what happens. Well, it's still going to be the same thing. But let's just take this as an observation. So we have to look at another financial statement again and see how these variables will change. And at the same time, still audit the steps involved. You understand what I'm saying?
Yes, please. Yes.
Exactly. So I appreciate your point and I appreciate your question. So this is something we will look at. We will still look at this furthermore. But for this, I think it's only EBITDA that agrees. All this is not agreeing. For as far as optimistic case is concerned, we are supposed to have an improvement here. What this means is that we're supposed to have an improvement here. And the improvement here is supposed to be the reverse case. That's how it should be. But we'll look into that further. That will be looked into. Do we have any other question? Is there another question? Okay, so I think there's no other question. So what we'll do is I will send another case study that will treat scenario analysis. So on the basis of that, we'll be able to assess what has gone wrong with our performance metrics here based on the scenarios we have set. All right, based on the scenarios we have set. But what I would also advise now is do go through the steps that we have and follow the steps, at least to be able to master the steps. Then in the course of the week, we'll look at another scenario and see how we can prepare the possible reasons for this and how we can correct it. Is that taken? So that's what we will do. All right. So we don't have any question, right? Any further question? Okay. So in the absence of okay. So in the absence of further question, we'll end the class here. Then I was saying that during the course of the week, I will send another question. I will also look into this. All right. So in the next class, we'll see how we can.
Are you sending the recording?
Yeah. You say what?
The recording of this particular class. Are you going to send it?
Yes. Okay. It's automatic. And what you can also do is you can also take this as assignment as well. We are all going to research it. You look at this as well and see if we can have any reasons why this is not an agreement. All right. So what I will also do on my own part is I will send another case study that will also tweet to observe what happens here.
All right.
You understand what I'm saying? All right. So thank you very much.
All right. Thank you.
So we're going to end this party. All right. Thank you.
Yeah.